What's up guys, welcome back to the channel. Today we'll be talking about institutional sentiment. Institutional sentiment can also be called smart money flow, that is understanding how the institutions flow in the market. Before the end of today's lesson, you'll be able to identify potential trend reversal with institutional sentiment. By having the general understanding of how smart money moves in the market, you can identify potential trend reversal. You can also anticipate price movement. You're going to know where price is likely going to move to. You will identify the exact area to place your trades and make informed trading decisions. So this is what we're going to cover for today's lesson. So if you are interested in content like this, consider subscribing to the channel. I'm Solomon Wisdom and here is Born to Trade. We have to understand that institutional flow refers to the collective behavior of large institutional traders such as the hedge funds, banks and investment firms. These entities have significant resources and advanced analytics and experienced traders, allowing them to influence the market trend and prices. Now, since they influence these market trends, we try to follow their footprints to make informed trading decisions in the market. Now, we have 5 major institutional sentiments, or you can actually call it 5 major smart money flows, which I'm going to give you in today's lesson. Before the end of these lessons, you will know the best way to approach the market and make money from the financial market. And the very first one we have on our list is what we call accumulation, and a lot of people call it a range. So let's see that. Now, accumulation phase in the market is where we have slow price action, and this comes with a lot of information which a lot of people don't pay attention to. Now, what is an accumulation phase, or you call it an accumulation flow? This is the phase in the market where we see slow price action. As you can see, price doesn't have any specific direction. Price is just offering a sideways movement. If you look at this particular area we have right here, you can see that we just seeing a sideways movement at this particular area. At first, price react to the upside. We have a retracement. We have this reaction to the upside once more. And if you try to pay attention to this particular area, you're going to see that this area is actually serving as a resistance level, because we've seen price come to the upside the first time. We see the rejection, and price comes back again, and we've seen this rejection. This particular low right here is actually going to serve as a support level, where a lot of people is actually going to pay attention to this particular area, because these lows are actually equal. Now, what we've seen at this area, the price came close to this area. We have the reaction to the upside, we have the retest, and we have another reaction. This is the third time price is actually returning back to this particular level. And you see, this is what we call accumulation phase in the market. So in order to understand the accumulation phase and be able to identify it in the market, this is area in the market where we've seen a slow price action, where price is moving slowly. Okay, we can actually call it a range. And you see, at this particular point in the market, a lot of transaction is actually going on. You see, a lot of people are buying and a lot of people are selling because of different reasons. One of the reasons could be some are seeing here as a resistance level, that's why they're looking to sell. Another people might actually be seeing here as a support level, that's why they are looking to buy. And you're going to see, like I said, a lot of people are actually doing a lot of things in the markets because of different reasons. And this slow price action right here is what we call the accumulation phase, and you need to understand this particular phase. People buying and selling in the market simply means that a lot of money is resting at this particular area. That means liquidity has been generated in the markets. A lot of liquidity resting above this high. Liquidity being money, that is money resting above this particular high. And most times you see me representing liquidity areas with $sign, and if I try to do that right now, you're going to see that this is actually a liquidity area for me, which means that a lot of money is resting above this high. And this is another low we have right here. And if you try to pay attention, this explains that money is resting at these lows because a lot of others are resting at the lows and at the high. Now you understand that liquidity rests above the highs and the lows. This is when we talk about the next phase, which is the liquidation phase. And the liquidation phase is simply price seeking that liquidity, where we see price going to take the liquidity in one side of the market, because from what you can clearly see from here, this is our liquidity areas, and at this point we see price react to the downside, going to seek the liquidity at this particular lows. So price coming to this particular downside means it's taking the liquidity at these lows. Anyone that is buying at this point, their stop loss is at these lows. Then price comes, takes the liquidity at this particular low, making sure that the liquidity at this low has been taken. So this is what we call the liquidation phase, and a lot of people actually call this the manipulation phase in the markets. The moment you understand, okay, this is an accumulation phase, and once there is an accumulation, we're going to expect a manipulation. This is going to help you avoid trading inside the range or during an accumulation phase. You will only try to approach the market after you must have seen price taking liquidity at lows and highs. Okay, that's you only approach the market after the manipulation phase. And have it in mind, we've covered the first phase, which is the accumulation phase. This is the second phase we have right here, which I called the liquidation phase or the manipulation phase. And after the manipulation phase, this is when we talk about the initiation phase. The initiation phase is another important phase if you want to understand institutional sentiment, because at this particular point we've seen that liquidation, price making sure that this liquidity has been taken. Now this is where we see the reversal to the opposite direction, because price has actually taken the liquidity, and during the phase when price took this liquidity, a lot of breakout traders were actually paying attention to selling to the downside, expecting more deeper drop to the downside. But this is not actually what we're going to see in the market. Most times you're going to see price reversing to the opposite direction. So when you see something like this, this simply signifies institutional footprints. And at this point, remember, you're only staying out of the market. You're not looking to get involved in the markets. Why are you not looking to get involved in the markets? Actually waiting for the institutions to give you signs. Once you understand the institutions have stepped into the market, you allow them run their manipulation phase, this initiation phase. Then after that, this is when you're going to look to approach the market and trade in line with the institutions. But at first, what we see right here is that this initiation phase is the phase where we see price reversing to the opposite direction. At this point, this could actually be a break of structure or a market structure shift. But have it in mind that once you've identified this, your initiation phase, this has to come with candle with large bodies, or we call it institutional candle. A candle that can actually signify institutional footprints. These candles usually moves with large momentum. Okay, we usually see these candles move with candles that has momentum, and at this point it has to break a structure, be it an external structure or an internal structure. If it doesn't break a structure, then it should present a change of character, or we call it a market structure shift. Now at this point, we had the manipulation and we have the initiation, where price moves to the opposite direction. And after this initiation phase, this is where we start to talk about the mitigation phase. And the mitigation phase is actually very, very important. And you see, this is exactly what the mitigation phase looks like. Once we have price breaking above this particular high, this is when we're going to anticipate the mitigation phase. And the mitigation phase is the phase which you look to enter the market, because definitely we're going to have a zone right here, which is going to be a demand zone or your order block. And this is the mitigation phase, where we expect price to come and mitigate orders right here. And I hope you know what mitigation means. At this point, when we had this manipulation, this is institutions entering sell position, and this sell position, the entering is just to sweep the liquidity at these lows. And once they sweep the liquidity, you're going to see them reverse to the upside massively with a candle with large body. And this is exactly what I said. We're going to anticipate that the institutions are going to reverse to the upside or to the opposite direction with candle with large body. Now remember, they have an open sell position. Now that they reverse to the upside with momentum, their sell position is still very much open. Now what they're going to do is you're going to return back to the downside for mitigation. And mitigation is simply reduction of risk, where you see the institutions coming back to close their open positions, that is the open sell positions, and then they're going to stack up more orders to continue to the upside. And the continuation to the upside is what we call the distribution phase. And this is exactly what the distribution phase looks like, where you see them mitigate this level. Then distribution phase means they're going to continue to the opposite direction. And one thing you're going to notice right here is that price firstly sweeps the liquidity at this particular high, retracement before we see the continuation to the upside. So these are the phases of smart money sentiment. Okay, this is the phases of institutional flow, how the institutions move in the markets. So this is what I need you to pay attention to. Firstly, we're going to see that accumulation phase where we're going to see a slow price action. So this is it right here. At first, we're going to see that accumulation area where they are moving slowly in the markets, accumulating orders. After the accumulation area, this is where we're going to identify that liquidity sweep area, that is the liquidation area where they're going to sweep the liquidity at some levels. Okay, just like this area being the liquidity area where the liquidity at these lows were swept, and from there what else can we actually see? You see how price expands to the upside, which is the initiation phase, price moving to the opposite direction. After this, that's when we're going to anticipate the mitigation, where price is going to come back to mitigate our level, and after that we're going to see the distribution phase where price continues to the upside or to the opposite direction. So this is simple. This is a very, very simple concept, and I'm going to show you a live example. So you see, this is exactly how smart money moves in the market, and this is my trading style. Okay, this is one of the style I use in making money in the financial market. So let's see a live example. Now this is gold. This is the 30 minutes time frame, and this particular price action, I caught this trade with some of the students in our VIP community. So let me explain this quickly so you'll understand. Okay, I'm going to explain it quickly so you're going to get a better understanding of how this works. Now, at first, we say we want to identify the accumulation area. Now, accumulation area being what? A slow price action. Now, from what you can clearly see, I hope you can clearly see where we have a slow price action, no clear movements. Now, you see how price is moving slowly at this particular area. You see it, we have this slow price action. Now, by looking at these particular areas, you already know that this is a liquidity area in the markets. Price is accumulating orders. Stop losses are resting above the highs and the lows. So you can actually mark this area as an accumulation area in the markets. Okay, this is an accumulation area in the markets where we see price building up orders. That's price accumulating orders at this particular area. Now, if you see this in the market, I guess you're not going to look to enter the market. Why? You're going to be waiting for the manipulation phase where price is going to sweep the liquidity at any side of this market. Now, at this particular point, this is where we're seeing price takes the liquidity above this particular high. You see that price takes the liquidity at the high, which is the liquidation phase, where we see price sweeping the liquidity at this particular area, and you see how price drops nicely into this particular area, making sure that the whole liquidity was swept. And not only that, you see price now initiates to the downside, which is the initiation phase, which we talked about. And I said the candles that is going to initiate out of this particular area should be an institutional candle. And you see how we have multiple bearish candles that we are pushing to the downside, and this is exactly the initiation phase. And another thing I said is that the initiation phase should at least break structure or cause a market structure shift. And you can see this is a very nice break of structure right here. You see how price breaks structure to the downside. Now, after the initiation phase, what do I talk about? Talked about the mitigation phase. So this is your zone right here. This could be your order block right here. Now, you see how price comes back nicely after the initiation to the downside. You see how price reversed, mitigates this particular level. What did I say about this mitigation? At first, you see how institutions push massively to the upside, making sure that the liquidity at these highs was swept. So at this point, they entered multiple buy positions. Now their buy positions were open when they moves aggressively to the downside. They are losing money at this particular area because their buy position is open when they sold to the downside. Now the purpose of this mitigation is for them to be able to close their buy positions. Okay, now they came back for mitigation, close their buy positions, stack up more orders, and you see how price reacted to the downside. And this is a trade that we caught this particular trade, but the thing is that personally I didn't take this trade, but some of the students in our community, they caught this trade because the analysis was shared last weekend and they made money from this particular setup. And you see, after the mitigation, we had the distribution to the downside. And if you try to take this trade, will you be able to make how many risks to reward? Let's see, almost 1:5. Okay, almost 1:5 RR. So it was a good one, but this was not actually the main example I wanted to show. Let me show you the main example for this, the one I prepared for this particular lesson, but I had to show you this particular one because it's actually a good example. So it's still on gold, and this is still on the 1 hour time frame. This is on the 1 hour time frame. Now at this point, this is exactly what I want you to identify in the market. Firstly, we have an accumulation area, and have it in mind that the accumulation area could be of many types. We have different sizes of accumulation. Price could actually accumulate for 1 month. Sometimes it could accumulate for 30 minutes. Sometimes it would accumulate for 5 minutes. But this particular one took a lot of time. This accumulation was a very large one, and if you see, this accumulation happened for about 7 days. That is, for 1 good week, price was in an accumulation area. And if you try to mark it, you're going to see this is what the accumulation area looks like. This is a range we've seen in the market. You see what this range looks like. Okay, you see the range. What does this mean? This means that we have money resting above this high. That is liquidity resting above the high. We equally see that liquidity is currently resting beneath these lows. Okay, liquidity resting beneath these lows, and this is simple price action which everyone should understand. Money resting above the highs and beneath the lows. Now at this point, when you see this price action, you're going to look to avoid the market for some time. And what are you waiting for? You're going to wait for the liquidation phase, because it's after the liquidation phase you're going to be looking to pay attention more to the market and look for area to get involved in the markets. You can see this is the liquidation phase we have right here after the price accumulates for some time, because accumulation simply means price is in the range. You see how price reacts from this low to the upside, little retracement to the upside. We've seen that retracement comes back to this low once more, that reaction to the upside, and we've seen that reversal to the downside again. So you see, this is an accumulation phase, very clean, and we have the liquidation phase where price takes the liquidity at this particular low, making sure that the liquidity has been swept. Okay, liquidity at the low was swept. Now what else are you going to look for? You're going to look for the initiation phase. Now after the liquidation phase, now we see how price initiates the upside. I hope you can clearly see the initiation phase, and you see it has a lot of bullish candles, and some of these candles are large, which is something we said we want to see in the market. And after that, what can you clearly see, the initiation phase actually gave a market structure shift. That is more like an internal market structure shift at this particular area. Now after this, what are we going to anticipate? We're going to anticipate the mitigation. Now you see how price comes back nicely into this level for the mitigation, and after this mitigation, what are we seeing? We're seeing price distribute to the upside. You see that distribution to the upside, and this is a very, very good price action which we've seen on gold. And what is the confluence to this? Because we have another confluence that helped us know that this is actually a high probability setup. You see, we have a level right here. This is a higher time frame demand level, and you see how price taps in nicely into this higher time frame demand level, which is a very good confluence that helped this particular setup to play out nicely. And I hope this makes sense to you, and you can actually pay attention to this and make money with this particular concept. Understand the accumulation phase, understand the liquidation phase, understand that price is going to initiate, and that initiation phase simply indicates, okay, institutions are actually stepping into the market, because it's very possible that price could actually manipulate and continue to the downside. So that initiation phase is just going to help you know, okay, institutions are stepping into the market, we have this shift, so there is need to look for mitigation. If there is no initiation, then mitigation is not going to exist. Okay, if price sweeps this liquidity and continue to the downside, that means you're not going to look to get involved. But after the initiation phase, we have this mitigation phase. Now this is where we get our entry and we ride the distribution. Very simple. All I want you to do right now is to visit your screen and backtest this. Like I always advise, after watching any lesson, try to backtest that so you build confidence and be able to apply it in the financial market. So thanks very much for watching this one. See you in the next one.